So today we're talking about traders versus investors, and which one are you? It's really interesting. Like when we're talking about traders, I mean, the first thing I think about is, movies like Wall Street, where traders are in the New York Stock Exchange with rolled up like shirts and sleeves and yellowed numbers. But trading nowadays goes so different. I mean, we're living in a digital age, and trading stocks is so different. Traders usually get in and out of a stock quickly. They go and make profit on price movement, while investors analyze the stock, analyze the fundamentals of a stock, and they stay in there in a position for a very long time, and sometimes they never sell, and they just keep adding to their positions every time the stock price goes lower. The stock is on sale. Um, Investors go in and buy more shares. So they have a certain amount of investments, and they just keep adding to quality stocks. So they're usually making profit, of course, on the price movements over time and on dividends. So a lot of investors rely on dividends for income. So it's pretty cool. So there are three components on both of them. So it's time frame, activity, and risk management. So let's determine time frame. So as a trader, your time frame is a very short period of time. Not very short. It depends. There is traders that trade every day. There's frequency traders that get in and out of a position within seconds or even minutes. And then, of course, there's traders that hold a stock for a couple of weeks or a few days and get out of their position. So, of course, what takes to that is traders use technical analysis. So they're looking at price charts, they're, um, they're using indicators. And I'm sure you've heard of the MACD and the RSI and all. So they're using those indicators and of course catalysts, so there's a lot of stuff they're looking for, and just to write up on a short term price movements, while an investor goes with fundamentals. They go with the fundamentals of a company. How healthy is the company? How much can it grow in the future? um, do they have dividends? Do they have a cash balance? What is their cash reserve? And how much is debt? And so there like is a lot of comparison. So they're really analyzing a company as a fundamental. So if you're an investor, whenever you invest in a stock of a company, um, you're you're thinking about buying a part of that company, and that is very important because you're very interested in the health of the company. Don't just blindly buy it. So the time frames is very long for an investor, and it's very short for a trader. Um, Risk management for traders is they usually set stop losses. They see what is my risk to reward ratio, and so they're setting their stop losses. That if they're losing a certain amount, a percentage, then it will automatically be sold for them. They have stop limits, so you can determine ahead when you're gonna sell your stock. So if the stock goes out up to a certain percentage, they're using a stock limit to sell out of that stock. And while investors, they don't really care about short-term fluctuation in a stock. They don't care about if the stock goes down for a short period of time because they know that it's a valuable company and that this eventually comes back up. And it's so true because if you look at the S&P 500 over the last 100 years, you will realize how much fluctuation goes on in a stock, or how much fluctuation goes on in the market, and you can see that it'll always come back up. So time frame completely different. Activity traders are usually trading stocks daily while the stock market is open, and investors, they might not look at their portfolio for a few days, and they just keep investing. Unless, of course, you're like me, I look at my portfolio every day, 10 times. But, professional investors don't do that. They know that eventually their stock comes back up and they're not willing to sell it anyway. So it really doesn't matter. So actually, you can be both. You can be an investor and a trader at the same time, and that's what most people do. Or, even hedge funds and all these institutions, they're usually both. You can use like options to buy stock as a lower price as long as you have the money to buy 100 shares. And you can hold on, have a portfolio where you hold on for a long period of time, and then at the same time you can have a little side portfolio where you're trading. And most of us do that, and I do that too. It's it's a way of getting into a high-end stock. So you're buying a company, you have to buy a good company, but you buy a company with good fundamentals that just had a bad catalyst, let's say bad earnings report, or and then and you buy it cheap and you hold on to it until the price comes up, and then you sell it and you buy a better stock. So it's a good way to, increase your portfolio and buy quality stocks. But yeah, fundamentals are, they look at balance sheets, um, at earnings reports, and just overall future growth of a company, while a trader doesn't really care about any of that. They just want to get into a company, uh, you know, and write the price up and then sell for profit. So I hope you like this video, and please come back next week. I post every Friday, and all I really want to do is give value to new investors, and simplify the terms a little bit if you don't know the terms of certain things, and give you a little bit fundamentals and basics on the stock market. And you should be so proud if you're starting to invest now and um, for your future. So I'll see you soon. Thank you so much.